Hi everyone, this is Gavin McMaster from Options Trading IQ. Today is Saturday the 8th of October and I wanted to just do a quick video tutorial today on how to trade credit spreads with your Optionshouse brokerage. It's a brokerage that I highly recommend, and I've had a couple of questions on how to implement these trades, so I'll just walk you through it now. When you log into your account, this is your screen. We'll head over to the options chains and let's assume that we want to trade. This is the RUT option chains, one that I like to trade a lot. I've had quite a lot of success with it. Now let's assume we wanted to put on a bull put spread. We thought the markets were going to either stay flat or rise, so it's a slightly bullish strategy, and we wanted to use the 510, 520 November strikes. What you can do is you can just click on either of the bid or the ask price on either of the options, and that will bring up this window here, and from here you can choose trade RUT spread. Okay, so this brings up your spread ticket, and what you want to do is you always want to sell the higher strike price when you're doing credit spreads, when you're doing the bull put spreads, and you want to buy the lower strike. So you want to make sure you get the same expiry date here. We'll pick 510, the lower one. Make sure you have put here, and here you see the bid and the ask spread. So with index options like RUT, the spread you can see is quite high. It's a 90-cent spread here basically, and you want to be trading something in sort of in the midpoint. Now the price that you want to enter is going to be, you never want to enter these trades as a market price, because what's going to happen is you're going to be selling it at the bid and buying it at the ask, which is only a difference of 10 cents. As you can see here, 10 cents sell is the market price. You generally don't want to do that. That's why these numbers are in bold here. This is, if you want your order executed straight away, these are the prices you would have to do. But what we want to do is we want to trade this option somewhere in the middle and this option somewhere in the middle. So for this one, somewhere around 670, 675, and for this one somewhere around 575. Okay, so limit sell. So 675 minus 575, we're looking at a price of around $1 would be the midpoint. Okay, now something I like to do every time before I enter one of these trades is just double check things before I enter the actual trade. I just double check the sort of price that I can expect to get. You may not be able to get the exact midpoint of each spread, but you want to be trading somewhere around that middle point. So what I just do is, rather than trying to work this out in my head, I just quickly put these figures into Excel and just manually calculate the midpoint. So we've got 630, 720, and 530, and 620. And then you can just take the midpoint of each one, which you could just do that by divided by 2 plus that divided by 2, and that tells you the midpoint. And then you can do that the same for that, and then the difference between the two spreads is roughly the midpoint where you want to be selling the spread. So $1 at the moment is our midpoint on this spread, and what you can do is, if you want to be a little bit conservative, maybe you're worried that the market's going to move against you as soon as you've placed the trade, you could maybe put your trade in for $1.20, and then maybe if the market sells down, the spread might increase to $1.20, you might get executed. Or if you wanted to execute it straight away, you might put it in at $1, or you could even put it slightly less than the midpoint at 95 or 90, and then you would most likely get executed at that price. So I generally like to put something at least at the midpoint. I never go below the midpoint. If I was going to trade this particular spread, I'd probably start it off at $1.10, maybe leave it there for 20 or 30 minutes and just see what happens. And then if I'm not getting executed, then I'll just gradually bring the price down until I do get executed. Sometimes I'll just put it in for a day order, and if it doesn't get executed that day, the order gets cancelled at the end of the day. Otherwise, if I'm happy to just keep that order sitting in there until it gets executed, I'll use a good till cancelled order. And what this means is that your trade, your order, will stay in the system each day until it either gets executed and you get filled on your order, on your credit spread, or you manually go in and cancel it. Another option you can do is all or none. What that just means, say you're trading 10 spreads, it'll just mean that, you know, it won't execute your trade unless you get all 10 filled. So, you know, if one of these orders could have got filled, one of these spreads, then it won't fill it until all 10 can be done. That's if you've got this ticked. I would usually leave that blank though. So then you just hit preview. Oh, the price type cancelled out. So 1.1 preview. Currently not accepting good till cancelled spreads. Okay, so there you go. Unfortunately, you're going to have to do this as a day order by the looks of it. This is a virtual trading account. It's not a real account, so it could be different in a real account. But that was the error message we was getting. Okay, also as it's a weekend here, it's just saying that the market for the security is closed, which is fair enough, and that the order will be submitted when the market opens. So we'll just double check everything here. Always a good idea when you're on this screen. Just double check. When you're trading credit spreads, you always want to make sure you're doing a limit sell, not a limit buy. Very important. That was our price. We've got a day option order. This is the margin requirement that we need to trade this spread with 10 contracts. So that's something to keep in mind. You need to know what your account balance is, you know, and how this margin is going to affect it. You also, you know, if you've got a $10,000 account, you don't want to be trading 10 contracts because that's 100% of your capital at risk in one trade. So generally not a good idea. Okay, and then you just place your order. And we can see here that our order was successful. So our order's in the system, and then come Monday morning when the market opens, if the price of this spread drops down to $1.10, we'll get executed. So that's it really. It's as simple as that. Very, very easy, guys. I know there's been some people who have been a little bit confused as to how to enter these trades, so I hope you found this useful. You know, if you've got any questions about Optionshouse or credit spreads, just shoot me an email, info@optionstradingiq.com. Also head over to the website, sign up for the email newsletter. You'll get a copy of my option strategy workbook, which goes through all the main option strategies, the risks, the returns, the payoff diagrams. You'll also get a sample trading plan. And currently at the moment, if you head over to the site, I've got a free 1 month trial of the IQ Trade Alert service where you can, you know, see what I'm trading. I'll give you a full trade breakdown showing you my stop losses, my profit targets, how I'm going to adjust the trade depending on what happens. So it's a completely risk-free trial for 1 month. So head over to the website, sign up today. You know, it's just recently been launched. We've had 4 trades so far, and we've had 4 winners. You know, one 35% return, another for about 15, another for 20%. So doing really, really well at the moment. So head on over and sign up today. All right, thanks a lot, guys. Have an awesome day, and I'll talk to you again soon.